Hello and welcome to Optotax. Joining us is CA Deepak Kumar Jain, who is a chartered accountant, company secretary, and a law graduate with over 24 years of post-qualification experience. Deepak has spent nearly a decade with Big Four firm, where he has played a key role in setting up and scaling indirect tax practices across South India. Over the years, he has advised Indian and multinational clients on GST, customs, FTP, SEZ and legacy tax laws across compliance, advisory and litigation. He is the founder of Accolade Advisors, a boutique consulting firm, as well as IndiaGST.com, a popular GST knowledge app, and founding partner at Lex et al., which offers strategic, legal and tax advisory through a global network of experts. Deepak has authored several books and regularly contributes to leading industry bodies like ICAI, BCIC, FKCCI and KCAA. Deepak, it is a pleasure to have you here. Welcome to the show. Let's get started. So in a business of high volume transactions, we have seen a lot of invoices that come in that don't possess the physical or the digital signature. What do you think? Does it really affect the eligibility of input tax credit? What kind of an audit should a compliance manager take in such a scenario?
I think you touched upon a very fundamental issue, Suresh. I think if I can, in terms of the number of audits or the number of kind of clients which we have handled, if I were to kind of branch out one such issue, I think this would be something in terms of input tax credit. This will be one which we always feel ki, with the number of invoices which are there, which are unsigned. I mean, is this something which is a risk or not a risk? So that issue certainly has been there. Maybe I'll kind of give a piece, but yes, just to kind of put it from a legal perspective, if we were to kind of say that every invoice needs to be kind of signed, then I'm sure half of the finance team will be running behind vendors asking for their autographs. Right. So we'll have to kind of look at law both from the intent perspective and from the objective perspective. Now, in terms of, let's say, let me first kind of cover the legality of it and then probably kind of come to the practical aspect of it. Now, in terms of legality, section 16(2), which basically kind of states that, yes, if I were to kind of take an input tax credit, I need to be in possession of a tax invoice. So that's the basic requirement. Now, if I were to kind of get into the rules, you have the rule 46, which basically kind of states that the invoice needs to kind of have specified contents. And one of those is something which is originally signed or digitally signed. Right. I'm not kind of considering the e-invoice, which is kind of enabled for specified kind of service providers. So wherever it is, if you read the rule with the section, it makes it clear that something which is originally signed or digitally signed is the only document on which you can kind of take credit. Right. So simpliciter, you need something which is originally signed, then it becomes valid. Otherwise, it is not as such. Now, if I were to kind of compare to the pre-GST regime, now we had, I think, rule 9(2) of the SunVat credit rules, where certainly documentation was key as regards taking SunVat credit, but then there was an exception which said that if there were certain particulars which were not on the invoice, but still the goods were received or accounted for, is enough or sufficient for taking SunVat credit. Right. But unfortunately, in the GST law, we don't have something parallel to this. So therefore, then the confusion kind of comes in, is it a substantive non-compliance or is it a procedural non-compliance? Right. If I were to look at the pre-GST regime, certainly by virtue of the proviso, it clearly made it a procedural non-compliance. But because this is not something which is there in the GST law, we still have to kind of answer whether it is substantive or not a substantive compliance, maybe procedural. Now, the objective, now certainly from a government's perspective, if they have kind of said that a document needs to kind of be originally signed or digitally signed, it is more to kind of bring in authenticity. Right. If a document which is originally signed basically showcases that it is authentic, something which is not creates a doubt. Now, if we were to look at courts always look at a test which is substantive or procedural. Now, let's take an example how courts would evaluate whether this is a substantive non-compliance or procedural. A common example could be what? It could be, let's say, you have employees who give rent receipts for supporting their HRA claims. Sure. There could be three scenarios to it. One is that they have paid the rent and they have a proper receipt to it. Second is a case where they pay the rent, but they don't have a signed receipt. They just have an unsigned receipt. Third could be a case where they don't pay the rent, but then they have a document which is signed and said that as if they have kind of paid. Now, a substantive thing would be that payment, and procedural would be the receipt. So certainly if I were to kind of look at in terms of this context from an invoice perspective, if a document which is unsigned, so long as it is corroborated, like say if it is a rental payment example, if I have an unsigned rent receipt, I could corroborate it with rental agreement, I could corroborate it with digital payment if that has happened, I could corroborate it with other things to kind of satisfy that from a sum and substance, a rent payment from this person to a specified, whoever is the landlord, has kind of happened. Likewise, from a GST input tax credit perspective also, it is important that yes, I have an invoice, but more importantly, in terms of substantive compliance, more important would be to see, have I received the goods, and in respect of those goods or services which I have received, I am making payment.
Right.
Now, that document, if it is unsigned, I believe is procedural non-compliance.
So then, would you mean to say that appearance in TOBI would be the more substantive compliance?
Yeah, so therefore, government has kind of built in certain checks and balances which strengthen these reportings. So if you were to see when GST kind of came in, the level of compliance as regards filing of returns was about 60 to 65%.
Right.
And with the kind of stress which kind of happened, where I have to kind of not only look at my compliance, but also look at my vendor's compliance, it has upped the compliance percentage from 60 to 65 to now 85 to 90. I think you take across any government or take across any kind of other statute, GST stands tallest as regards compliance is kind of concerned only because of the kind of stringent which they have kind of brought in. So certainly with that kind of, be it in terms of digital payments or be it in terms of this, I certainly see that while this is something which is, I mean, if you read the rule with the law, certainly having a originally signed invoice or a digitally signed invoice is a requirement. But if one were to kind of look at it from a substance over form, so long as I'm able to corroborate, wherever I have unsigned, so long as I'm able to corroborate with proper evidences which evidence the transaction, it should be still fine.
So in conclusion, you are trying to say that if we have received the goods or the services and we can evidence that, then obviously we are eligible for input tax credit.
Yeah, so receipt of goods, accounting of the transaction, payment of that are all the, those are the substantive, I would say, transactions or situations which evidence taking credit. A document evidencing them are procedural in nature.
Okay.
That way. So long as you have a document which is issued by the vendor, see normally what happens if you see the any client for that matter, leave the e-invoice portion. So anything which is other than e-invoice, I am sure that half of them would be something which is an unsigned. So you'll have the regular practice of saying it's a computer generated invoice, does not require signature.
Yes.
You go to a restaurant or you go to a, let's say, kind of store. All of this basically you have a practice of an unsigned invoice, while wherever it is e-invoice or otherwise, while those are there, but wherever it is otherwise, certainly gets an e-invoice. So having an unsigned invoice from a internal control perspective is not suggested. Maybe from a process control, companies should look at having a threshold which says anything which in excess of a particular kind of amount, I shall insist for a proper signed invoice. So that's more from a control perspective. But from a legal perspective as regards a position, certainly just because I don't have a signed invoice, will that disentitle my credit? The answer is no. So let us not take the exception to the rule. Exception should remain exception. So the ordinary rule should be that I should insist for original signed invoice in all cases, but wherever it is not possible for practical reasons, then even an unsigned invoice should not take away the substantive right to claim ITC.
Sure. So on that side also, can you just elaborate what is the relevance of place of supply? We understand that place of supply is very critical for claiming input tax credit. Can you with live example let us know as to in cases where the place of supply will disentitle the eligibility to input tax credit?
Yeah, I think this is another pertinent question I think which you raised, Suresh. So place of supply, I mean, it's like, if I can put it simply, it is like a GPS coordinate, right? You have your correct coordinates, then you are right to kind of take the credit. But if your coordinates for whatever reason are not in the, I mean, let's say if your coordinates are at another place and you are at another place, that is a mismatch. So place of supply under GST law is very, very unique. India has kind of borrowed that from the European Union VAT law. Where European Union, it's a union of countries, India is basically a union of states. So certainly from a concept perspective, place of supply is kind of brought in, where you have I mean, in terms of Indian scenario, you have each state having the equal power or the authority to kind of tax it. Place of supply becomes very critical. One is from an output tax perspective, I need to kind of determine and pay tax to the correct. But for the person availing ITC, if the taxes go to a wrong state and he is in another state, that creates a mismatch. So maybe I can probably take a couple of certain examples,
Sure.
which can kind of state how place of supply could kind of, if it is not kind of done in a particular manner, could kind of frustrate. Because see what happens in a business transaction, the margins are very low. And for a particular transaction, if you don't get a due credit, that could kind of take away. I mean, if it could completely lead you into a negative margin. So
Yes.
place of supply therefore becomes very critical. Now, the simple example could be, let's say, if I do a bill to ship to, that is, let's say, we'll take the ordinary case first, where I'm, let's say, in Karnataka and my customer, let's assume, is in Tamil Nadu. So I bill to and ship to my customer in Tamil Nadu. Place of supply, therefore, is Tamil Nadu. There is, I'm sure, no issues as regards that. But let's take a twist in terms of that, where the customer says that you don't deliver it to me, I will come and pick it up from your place. So I am the supplier in Karnataka. I know that I'm billing to a customer in Tamil Nadu, but I don't undertake movement of those goods to Tamil Nadu. Customer comes to my place, takes the delivery and moves in.
Right.
Now the question here is, what is the place of supply? Now for me, ordinarily it would be the place where I hand over the goods. But if you see under section 10(1), from a GST perspective, the place of supply, wherever it involves movement can happen by the supplier or by the recipient. In this case, it is happening by the recipient. So after picking up the goods from me, he is taking it, consider, to Tamil Nadu. So place of supply, technically, which I need to kind of apply is not Karnataka, is Tamil Nadu, because goods ultimately move to Tamil Nadu. That way. So for that, I mean, if I'm the supplier, I would need evidence to say that the goods actually moved in. So I need to retain those evidences to say, if I have to kind of showcase the place of supply is Tamil Nadu, I need to retain that evidence to say that the goods got built from Karnataka, got delivered to Tamil Nadu, and here I may not have delivered it, but my customer has picked up the delivery, but there is these e-way bill or other documents to evidence that after picking up from my place, it got delivered to Tamil Nadu, in which case the place of supply becomes Tamil Nadu. So if a supplier, in this case, declares Karnataka as place of supply, but technically the customer may not have a registration in Karnataka. So if I declare Karnataka as place of supply, he loses a potential credit.
Yes.
So that becomes a mismatch. Likewise, let's say from an import transaction. Now, consider that I may have a place of business in Maharashtra and Karnataka. I have imported these goods at Mumbai port, but they are meant for, let's say, Karnataka. Imports happen through CHA. Consider that the CHA gave my Maharashtra GSTN for a Karnataka import. What would happen? The bill of entry will flash Mumbai or Maharashtra GSTN, where though the place of supply, the consumption, is meant or intended to kind of come into Karnataka. So document would kind of show place of supply as Maharashtra, but the actual consumption is which is Karnataka.
Sure.
So likewise, I'm sure there are multiple examples. In fact, on let's say renting of a mule property also. So there are I would say a lot of industry-wide different views which are there. In case of renting, let's say if I own a property in say Kolkata, question is can I kind of sitting in Karnataka pay GST in Kolkata or West Bengal, or do I need to kind of take registration there? Now certainly the output tax and the input tax both have a force of interaction. So if I'm, let's say, a service provider, I need to kind of ensure that as an output service provider, I'm entitled to take credits. So from a place of supply perspective, if I'm required to register for this in Kolkata and I don't take that and I raise my invoice from a state which is outside that particular state, then there is a mismatch.
So then why can't we charge IGST on such an invoice?
Yeah, certainly. So while we charge IGST, what will happen to charge IGST, you'll also be entitled to certain credits.
Yes.
Had you taken registration in the state of West Bengal, you would have taken what credits? You would have taken the credits in the state of West Bengal, right?
Right.
But to do this, what would you do? You'll take the credits of the place where you are registered. So that creates a mismatch. So therefore, wherever the place of supply in these cases require you to take registration, ITC follows those. So if you have to take registration in the state of West Bengal for a property where you're renting or doing managed services, it requires you to take ITC in those places only.
Sure.
If you take it in a place which is outside,
Yes.
that also kind of creates mismatch. So many people kind of take a position. In fact, many industry experts also are of the view that so long as you said, I pay IGST in that particular state, I'm not kind of frustrating. But that is okay so long as I don't take ITC. But if you are eligible to take ITC, then that kind of methodology may not be kind of correct.
Sure. So another thing which we have been seeing in large businesses, we get invoices where it says buy two get one free.
Yeah.
Do you think that would impact eligibility of ITC in any way? Can you illustrate with examples how to comply with such an invoice and take full credit?
Yeah, so buy two get one free is a marketing strategy, but from a tax team's perspective, I think it is while it is their delight, it is a plight for the tax team. Under the GST law, anything which is given free will have restriction as regards ITC is kind of concerned. So on the plain face of it, if I say buy two get one free, it basically says that I'm selling two for a particular price and I'm offering free something which is, let's say, one. While anything given free under the GST law lacks consideration, gets treated as a non-taxable supply, and something which is a non-taxable supply, any purchases done for a non-taxable supply gets restricted in terms of credit. So on the face of it, if buy two get one free, while you can take credit on those two, but the third which you have sold free, you're restricted in terms of credit. So that's the implication. But on this, I think we have a government circular. I think it is circular number 92, which was issued in March 2019.
Okay.
Now, that circular is something which is favoring the industry. In terms of the circular, very clearly it says that while you may have offered it as buy two get one free, you will have to read it as if it is buy three at the price of two. In the circular, it was buy one get one. So it is buy two at the price. Buy two.
Are you meaning to say that the government has given a clarification that the value includes the price for all the three products, even though one product is given free of cost?
Yeah. So that is what they have kind of contemplated, and that's how the circular is kind of more in the favor of industry. While on the face of it, totally agree with the circular because it is something which is the real intent. You'll hardly find I'm sure there are people who are kind of sitting in from industry in the government who would have drafted such circulars, but otherwise from government, I'm sure getting a circular of this nature would have been difficult. But that apart, what the circular has not considered is you have the compliance towards, let's say, the legal metrology law or the consumer, I mean, it's a consumer protection law, right? So under the legal metrology law, if you offer something as free, you shall give it as free. I can't take an assumption or a presumption to say that it is included in the price of something. So if I buy two, get one free, under the legal metrology law, I shall give that as free. I can't say that the price or the value of that is included in something else. So you can't have a compliance. I mean, I'm sure if we are from industry, right? I can't say that I'm compliant from GST and non-compliant from a legal metrology law. That way.
Yes.
So that is something which probably the circular has not kind of done. While however good the circular is, but I think from a industry, if you were the head managing the tax, I would suggest that you should not have a scheme of this nature. Buy two, get one free, while today you have the circular to support you, but at any point of time, if this is litigated in any manner, if it goes to the legislature has every right to deny the credit. So you're exposing yourself for something which can kind of come in. When you can do buy two at the price of one or buy three at the price of two, you shall try and kind of not do buy two, get one free. In fact, in my kind of practice, we have kind of had some of our clients change their, it was very difficult to have the marketing team do that, but certainly we were facilitators to kind of bring about some changes. Example could be that, like say in the hospitality sector, wherever you take, let's say, a room on rent, right, you get breakfast complimentary. So that is something which is ordinary, right?
Right.
Now, rather than saying breakfast complimentary, we started showcasing saying that yes, the room package has certain facilities, which could be, let's say, the Wi-Fi, it could be the breakfast, and the package includes these. So for the customer, he's looking at his end cost, right? And then from a package perspective, it showcases multiple things. So it gives more in terms of a bucket. Likewise, let's say if it's a educational industry, they often kind of, they would want, let's say if you go to, let's say a CA foundation to enter to final, they'd want to kind of induce you to say that you shall continue being with us. So what happens is if you kind of come in directly at inter and not do foundation, there is an additional price. So if you come in at foundation, do inter and then complete final with us, certainly there is a preferential pricing. So rather than saying that you come, if you do inter, foundation becomes free, we always say it is more in the nature of a package, right? So if you enroll for inter, you also have enrolled for your foundation. Right. Likewise, let's say if I have bought a car, rather than saying insurance is free, we say that yes, naturally the car has an element of insurance which is kind of included, a value worth, let's say 25,000 included in the price of the car. So these are things which you could look at having rather than calling something free. While the circular certainly is good, but if it is contested, certainly can kind of go against the company.
Sure.
And ITC is anything which is free, right, can kind of hit the company very hard. And marketing schemes like these are not for one kind of transaction. They are for substantive number of transactions. And if an implication kind of comes in, it therefore becomes quite substantive and huge.
Sure. Also, most of the taxpayer receive financial credit notes or GST credit notes for post-sale discounts, which are for marketing or for sales returns. How do you think whether this would be eligible for input tax credit?
Yeah, so financial credit note or commercial credit notes are transactions which are outside the GST law. Now, if let me talk about the credit note. So here is a case where I have an outward supply, and under the GST law, you have under certain circumstances where you can issue a credit note.
Right.
One could be, let's say, the sales return.
Right.
Or there could be cases where you have overstated or understated a value. If you have overstated, you issue a credit note to kind of bring it to the value which you would want. Or if you have charged a rate which is higher, then you give a credit note for the differential rate. Or there could be certain corrections, right? So those are the cases where you kind of bring about. So that's where you have a GST credit note, and all of that comes with a certain timeline. Now, wherever you give, let's say, certain incentives which are known at the time of sale, there again you can kind of give GST credit note and then happily kind of disclose it, and then kind of comes into the chain. But the issue kind of comes in, or the entire problem statement is where you issue credit notes which don't have GST. So these are the financial credit notes. So there it is only the value of discount or value of reduction in terms of negative value, if I can kind of call it, which is kind of done. And from a customer perspective, that nets off the payable which he has to kind of do to the supplier. So if I take an example here, let's say if I raise an invoice for 10,000 with a tax of, let's say, 1,800, total payable becomes 11,800. But if I give a credit note which is with tax, it reduces both value and tax. But if I give a credit note which is financial or commercial, it only reduces the value, not the tax. And it is not reported from a GST perspective. So there are significant challenges, I would say, in GST law for financial credit notes. I mean, this is something which I foresee to come, but as present, it is a common practice where many of them are issuing these financial credit notes.
Absolutely. It's been 7 years of GST, and to overcome various practical issues, financial and commercial credit notes are being issued left and right.
Yeah, absolutely. Yeah. So because and somewhere if this really becomes an issue, I'm sure there is where I see a sleeping volcano becoming live. Now, let me kind of illustrate how this could kind of impact the company. Now, every provision, right, every law in certain cases has certain things which are where they would want to kind of plug a mischief. So they would want to kind of look at those stray exceptions and generalize them and kind of apply them to all. So likewise for ITC, there is a mischief provision in section 16.2, I'm so sorry, where in 16.2 what it basically says is if I'm the person who's wanting to kind of take credit, I can take credit to the extent the value I pay and the tax payable thereon. So if there is a financial credit note which kind of comes in, because financial credit note reduces the value, right? So then the implication is what? That to that extent and the tax payable thereon is what you can kind of take credit. So just to illustrate, in the example which I gave, 10,000 plus tax, 10,000 plus 1,800 is the original invoice, and consider that I gave a financial credit note for 10,000. So first it was 10,000 plus and 1,800, 11,800 minus 10,000. So what have I done? I have only passed on tax to my customer. So the mischief here is what? people who have ITC, if they want to pass it on to their customers, can conveniently do by raising an invoice, charge applicable tax, and then raise a financial credit note without impacting the output tax. Then my ITC gets shifted onto my customer. So to plug that is where you have the 16.2 provision to say that wherever when you would want to kind of take credit, the amount on which you can take credit is the value and tax payable thereon. Here the value by virtue of financial credit note will become 0, tax payable on 0 will become 0. Yes. So people, but now what will happen is, if you see the industry, most people are kind of taking the full credit. They are saying that, see, so long as I have paid the tax to my vendor, vendor has paid it to the exchequer, where is the issue? So there is, I mean, this is 16.2 is the mischief which can kind of come in. But on this, we have a circular which government has kind of issued, where on financial credit notes, I think here again that circular number 92 was issued. Then somewhere in June, there was another circular 105 which kind of came in. And then in October, that circular number 105 got withdrawn. So what has the government done? They issued a circular saying financial credit notes is okay, does not have an impact as regards credit is concerned. And then they issue another circular withdrawing that. So it is like chad bhi mera, pat bhi mera. So they have left the entire war zone open. Yes. Right? So they could, I mean, people who have done also, they have kind of, they don't know whether they have done correctly. People who have not done also, so it's basically kind of playing. So somewhere government has not, I mean here particularly, has not kind of come out with a clear position. And certainly wherever such circulars which are issued and then withdrawn, I think there also needs to be an equal immunity, because people have relied on the circular and they are doing it. But unfortunately, we don't have such kind of a immunity in tax. Then what happens, an innocent taxpayer gets exposed to significant kind of implications. And the implications is not on the supplier, implications is on the person availing credit. And more often what happens, because of the way the margins are, if a due credit gets denied, it comes with interest penalty. And it takes away or makes him completely out of business. So therefore, what you touched upon, Suresh, is a very, very important aspect, right? And this is something which I see that if a show cause notice were to be issued, other than let's say reconciliation, this could be something which will kind of cover maximum number of assessees, because that's the trader community which India has, and that is the what do you say, the ordinary that the number of credit notes which are financial credit notes and commercial credit notes which are flowing in is that much in number.
Considering the restriction imposed under section 34 for a GST credit note, the issuance of financial and commercial credit note has been left and right.
So one aspect is that GST law is very restrictive in terms of when can I issue a GST credit note. But what is left open is that yes, I need to kind of issue credit notes which are not something which is provided for in the GST law. What happens to that? So the mischief rule is where the issue is. And that's where I think industry has to be very, very cautious about it. While you could issue financial credit notes, it should be more of an exception and not something which is ordinary. Sure. There are several ways where you can plan your business, achieve the same result in the four corners of law. Financial credit note is not the only way to achieve the end result. There are ways in which you can kind of mitigate and still achieve what you want to, other than by way of issuing a financial credit note. So the urge would be to follow those rather than issuing financial credit notes as an ordinary practice.